All right, so welcome to another video. Today, what I want to do is share with you some holy grail investing and trading advice that you really need to hear. So stick around. We're going to go ahead and cover that. If you need to learn a little bit more about trading and investing, check out tradersfly.com, and you can, of course, check out the Critical Charts website as well. So here, what I share with on the Critical Charts is just to give you some ideas and perspective of different charts, sometimes stock charts, sometimes other charts that you may need to watch and take a look at. Normally, I work with people one-on-one for trading options and investing, and get them to really understand the risk management behind it. So as we take a look at this investment advice, what a lot of people do when they go in and they look to buy a bunch of stocks or shares is they ultimately look at a pie or a portfolio basis, and this is kind of what is taught in a lot of books in school. And unfortunately, it doesn't do justice when we look at it in a book because it's tough to really assimilate things further down the road. So what people do is they look at, okay, well, why don't you buy 4 or 5 different investments that you have, and let's say you have $100,000 here. Now what you're doing is you're allocating $20,000 in each segment, 20, 40, 60, 80, 100. So you got $100,000 spread across 5 stocks. The difference or problem with this issue is that if any one of these takes a dip of, let's say, 20%, like you've seen on Facebook here, or Meta that has recently plummeted over the last year. So take a look at this. It's just going down and tanking, along with many other companies. Like you take a look at Lyft, even Microsoft has been going down quite a bit. So the issue here is, let's say you take a haircut and this goes to 10,000. And you got the same thing here where this now goes to 10,000 and this thing goes to 10,000. And now all of a sudden you've got 30 grand here. Maybe over here you've still got your 40 grand remaining. So you're down to 70 grand out of your 100 grand investment. And that's a bit of an issue and problem, because what you're doing here is you're concentrating a lot of risk into only 5 segments. I mean, you're really at 20% at each point, right? You got $20,000 out of the $100,000, and you're taking a large chunk. The larger the capital that you have, let's say I've got a large chunk of capital here and I've got $100,000, the more spread out I need to be. So really, when we start looking at a pie shape here, what we want to do is actually have a lot of micro investments all over the place and a lot of trades all over the place at different points, at different zones. This way, at any given point that one trade goes against you or that stock, you're protected. Now you might say, why don't I go and just do SPY or SPX? Well, you could do that. Unfortunately, again, it's tied directly to one specific thing. And if you know a couple of different trading strategies, which I talk about in our Traders Fly site, you could do things like iron condors, you could do verticals, you could do bearish, you could do bullish. There's diagonals, calendar spreads. So there's a lot of different variations of spreads that you could do. But now, as you spread these things out, you've got positions all over the place at different points, different times. And now, at any time, if any one of these areas is done, dead, gone, it didn't work, at least you have a lot of the pie left over. Okay, it's like having a basket of nails. You lose one, it's not a big deal. So what many people do is they just tackle on too many positions all at once at one point. Whereas instead, what you want to be doing is you've got, something like this, where I've got, instead of just like 1 or 2 positions, I got a position here, 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 another position, 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 position. And you got a ton of positions here. So this way, all of these things right here are creating a lot of diversification for you, where I'm not just concentrated or focused on this one thing, or just verticals, or just butterflies, or diagonals. It's not one thing, it's spread out. So some of them make a little bit more than others, and some of them don't make that much at all. But the point is you're spreading capital in different zones to be able to go ahead and handle what you have happening, going on, or if it goes against you. Some points you might even just have 5 shares. Look at this one. I got Microsoft. I've only got 5 shares in there. But the point is it's spreading capital and spreading risk. Okay, I've gotten in it at a different point, different date, different time. I'm spreading that capital. This one's a little heavy on lows, but the point is that we're just trying to spread capital. And this is not what many people do. A lot of people, they go in, they put everything in all at once, at one spot, at one time, and then that creates a problem. So what you want to do is have a lot of legs to stand on, okay, for your table. And each pillar here that you have creates a good solid base and foundation, to where if you've got a structure, Okay. And if you've got this structure and it falls down, or this one pillar is gone, the rest of the pillars are holding it up. So again, if you lose two pillars, you're okay. If you lose three pillars, you're okay. But for a lot of people, what they do is they have one or two pillars that are gone, or one or two stocks that do really poorly, and all of a sudden their portfolio takes a dive, and it's terrible, and it's not working as well. And now you've got a lot of fear, panic, and it's like it totally takes you down. Whereas you need to be concentrated so thinly to where one part doesn't really take you out. And this is one of the same things that Warren Buffett does, that if you like the Warren Buffett strategy investment, he's got a bunch of positions, bunch of companies all over the place, right? It's not like just five big ones. It's a lot of stuff all over the place. And you can do the same thing, just don't allocate as much. Look, if you're trading 100 shares in one company, and you only got five companies, you could just go ahead and do 2 shares or 5 shares. You might say, well, I can't do much with that. Yeah, but at least you're understanding how to spread risk, manage money, and watch out for diversifying yourself across different areas and sectors, industries, different strategies, different things. And that way the market can't take you out. So anyway, I hope that helps, gives you some insight. Definitely check out the Critical Charts website and learn a bit more from here. Check out the Traders Fly website. There's a lot of things I do when I work with people one-on-one, and really teaching them how to trade, invest, and deal with the option side of trading. So thanks for joining me. Enjoy the rest of the day ahead, and I will see you next time.